If your portfolio looks like a roller coaster, you're a thrill-seeking investor. The recent market movements have been nothing short of a wild ride, with ups and downs that can make even the most seasoned investors feel a bit queasy. But is this roller coaster ride something to be excited about, or should we be buckling up for a potential crash? Let's see if this market rally is worth the ride. Analysts are poring over data, trying to make sense of the current trends. Are we looking at a sustainable growth period, or is this just a temporary spike that will soon fizzle out? The global market is on a high after last month's carry trade shock. This unexpected event sent ripples through the financial world, causing a surge in market activity. Investors are riding this wave, hoping to capitalize on the momentum. Investors are seeing short-term gains, but the big question is, how sustainable is this rally? Short-term gains can be exhilarating, but they often come with increased risk. The key is to determine whether these gains are built on solid foundations or if they are just a house of cards waiting to collapse. Here's the scoop. The Fed is likely to cut interest rates soon, which could provide a boost to the market. Lower interest rates generally make borrowing cheaper, encouraging spending and investment. And the Bank of England has already dropped its rate to 5%. This move is aimed at stimulating the economy, but it also raises questions about the underlying health of the financial system. Are these rate cuts a sign of strength, or are they a desperate attempt to stave off a looming crisis? Sounds like a good sign, right? On the surface, lower interest rates can be seen as a positive development. They can lead to increased consumer spending, higher corporate profits, and a more robust economy. But hold on, there's more to the story. While lower interest rates can provide a short-term boost, they also come with potential downsides. For one, they can lead to higher inflation, which erodes purchasing power and can create economic instability. High inflation is still a major concern. Despite efforts to control it, inflation remains stubbornly high in many parts of the world. This can lead to higher costs for goods and services, squeezing consumers and businesses alike. And don't forget about potential fiscal policy tightening. Governments around the world are grappling with how to balance their budgets while supporting economic growth. Tightening fiscal policy, such as reducing government spending or increasing taxes, can slow down economic activity and dampen market enthusiasm, and the lurking risk of an economic slowdown. The global economy is interconnected, and a slowdown in one region can have ripple effects across the world. Investors need to be mindful of these broader economic trends and how they might impact their portfolios. These factors could rain on our market parade. Just when things seem to be going well, unexpected events or policy changes can quickly turn the tide. It's important to stay vigilant and be prepared for potential downturns. And then there's the carry trade issue. The carry trade, where investors borrow in low interest rate currencies to invest in higher yielding assets, can create significant market volatility. Policy differences between the Fed and the Bank of Japan could bring this problem back into the spotlight. Divergent monetary policies can lead to currency fluctuations and impact global trade and investment flows. It's a complex dance, and investors need to stay on their toes. Navigating these market conditions requires a keen understanding of both macroeconomic trends and individual investment opportunities. Now let's talk about India. Amidst the global market turbulence, India has managed to maintain a relatively stable economic environment. While the global market shakes, India has been relatively stable. This stability is partly due to strong domestic demand and prudent fiscal and monetary policies. It's not completely immune, but it's holding its ground better than most. Indian markets have shown resilience, but they are not entirely insulated from global shocks. Investors should keep an eye on both domestic and international developments. So, what's an investor to do? With all these variables, caution is key. Diversifying your portfolio and focusing on long-term growth rather than short-term gains can help mitigate risks. With all these variables, caution is key. Experts suggest a balanced approach, combining both defensive and growth-oriented investments to navigate the uncertain landscape. Experts suggest focusing on value stocks over growth stocks for the short to medium term. Value stocks, which are typically undervalued by the market, can offer more stability and potential for steady returns. They might not offer the same thrill, but they could provide more stability. In times of market volatility, stability can be more valuable than high returns. In summary, the market rally is exciting, but it's not without its risks. Investors need to stay informed and be prepared for potential challenges. Stay informed, stay cautious, and let's navigate these financial waters wisely. By staying informed and making prudent investment decisions, you can better manage the risks and opportunities that come your way. Thanks for watching. We hope this analysis has provided you with valuable insights into the current market conditions. Don't forget to like, share, and subscribe for more insightful market updates. Your support helps us continue to bring you the latest financial news and analysis.